Imagine putting $100 into something in 2013 that most people thought was a toy for internet nerds. Today, that investment would be worth more than most people's houses. This isn't a story about luck, it's about why individuals, companies, and even governments now treat Bitcoin as digital gold. In this video, we're covering what Bitcoin actually is, and 4 real reasons people invest in it, plus the risks no one should skip. This isn't financial advice, it's information to help you make your own decision. Let's start with the basics. Bitcoin is a digital currency, but unlike the money in your bank account, there's no central bank or company behind it. Instead, it runs on a network of thousands of independent computers spread across the world, all following the same set of rules. Every transaction ever made is recorded on something called the blockchain. Think of it as a massive, shared receipt book that everyone can see, but that nobody can secretly edit or erase. Because the network is spread across so many computers in so many countries, there's no single point of failure and no single authority in charge. Nobody owns Bitcoin the way a company owns a product. It's more like a protocol, a shared set of rules that anyone in the world can use, without asking permission. Here are 4 reasons why you should think about owning Bitcoin. Reason 1. How Bitcoin is fundamentally different from the money you use every day. The dollars, euros, or any national currency in your bank account is called fiat currency, meaning it has value because a government says it does, not because it's backed by something physical. A central bank can decide to print more of it whenever it wants, which affects how much that money is worth over time. On top of that, your bank account is controlled by a third party. A bank can freeze it, a government can restrict it, and in some countries, people have woken up to find their access to their own savings limited. Bitcoin was built to work differently. No central authority can create more of it on demand. The supply is fixed by code, not by policy. And if you hold your Bitcoin in your own wallet rather than on an exchange, no bank or government can freeze it or take it from you, because there's no third party holding it on your behalf. That's the core trade-off. Fiat currency is easy to use and backed by institutions, but it's also controlled by them. Bitcoin removes that middleman entirely, which is exactly why some people see it as a step toward financial independence. Reason 2. Inflation versus finite supply. Every government-issued currency can, in theory, be printed without limit. When more money enters circulation faster than the economy grows, each unit of that currency tends to buy less than it used to. That's inflation, and most people have felt its effects directly at the grocery store or the gas pump. Bitcoin was designed from day one to work in the opposite direction. There will only ever be 21 million Bitcoins in existence. That number isn't a marketing promise, it's hard-coded into the software that every computer on the network runs, and changing it would require basically the entire network to agree to break the system's core rule, which in practice doesn't happen. New Bitcoins are released on a fixed, predictable schedule that slows down over time, roughly halving every 4 years, until the final coin is mined sometime around the year 2140. This built-in scarcity is the main reason Bitcoin earned the nickname, digital gold. Much like gold can't simply be created out of thin air, neither can Bitcoin. For investors worried about their savings losing value over time, that fixed supply is a big part of the appeal. Reason 3. Bitcoin's price history, and this is the part that scares off a lot of newcomers if they don't understand the pattern first. Since Bitcoin launched, it has moved through several major boom and bust cycles, roughly every 4 years, often tied to that halving schedule we just talked about. In each cycle, the price has rallied to a new all-time high, then crashed dramatically, sometimes losing 70 to 80% of its value in the following months. If you only looked at any single crash in isolation, it would look like the end of the story. But zoom out, and a different pattern shows up. Despite every one of those crashes, each cycle has historically ended with Bitcoin eventually climbing to a new high above the previous cycle's peak. Early investors who bought in 2013 experienced multiple brutal crashes along the way, yet still ended up far ahead if they held through the volatility. That said, this pattern is not a promise. Past cycles don't guarantee future ones, and there's no certainty that Bitcoin will keep following the same shape going forward. What this history does show is that short-term price swings, even severe ones, have not, so far, changed Bitcoin's long-term trajectory. Understanding that pattern is essential context before looking at the price chart and panicking during a downturn. Reason 4. Adoption. Bitcoin started as an experiment used by a small group of early internet enthusiasts. That's changed dramatically. Today, individual investors hold it alongside stocks and savings. A growing number of publicly traded companies have added Bitcoin directly to their corporate balance sheets, treating it as a reserve asset similar to how they might hold cash or gold. Major investment firms now offer Bitcoin exchange-traded funds, or ETFs, which means someone can gain exposure to Bitcoin's price through a completely normal brokerage account, without ever setting up a crypto wallet or learning how private keys work. That single development opened the door to a huge amount of institutional and retirement money that simply couldn't participate before. On top of that, some countries have explored using Bitcoin within parts of their financial systems, and payment companies have added support for it alongside traditional currencies. None of this guarantees Bitcoin's future. Adoption can slow down as easily as it can speed up, but the trend over the past several years has clearly moved in one direction, from niche experiment towards something increasingly built into the mainstream financial system. Now, to be fair, none of this means Bitcoin is a safe or guaranteed investment, and this next part matters just as much as everything before it. Bitcoin is extremely volatile. As you saw in the price history, drops of 50 to 80% over relatively short periods have happened multiple times, and they can happen again. If you're not prepared to see the value of your investment cut in half, or worse, this may not be the right fit for you. Regulation is another factor. Rules around Bitcoin vary significantly from country to country, and they can change with little warning, which can affect its price and how easily you can buy or sell it. There's also the matter of security. If you hold Bitcoin in your own wallet rather than on an exchange, you're responsible for protecting your private keys, the password-like code that gives access to your funds. Lose that code or have it stolen, and there's no bank, no customer service line, and no password reset option to get your funds back. That responsibility is the flip side of the independence we talked about earlier. Taken together, these risks mean one thing clearly: never invest money you can't afford to lose, take time to actually learn how to store it securely before buying a large amount, and never treat Bitcoin as a guaranteed or quick way to get rich. That's it for today. Bitcoin isn't a miracle or a scam, it's a tool with real advantages, from its fixed supply to its growing adoption, and real risks, from volatility to the responsibility of self-custody. The decision of whether it fits your own goals is entirely yours. If this video helped you, subscribe and drop a comment. Which reason stood out to you most? See you in the next one.